Test, test. Can you hear me okay? All right. First of all, just want to welcome everybody. Thank you for coming, and thank you for inviting me to do this. I really do appreciate it. For those of you who don't know me, I'm Troy Weiss. I'm a certified public accountant here in Rifle. I've been doing this for about almost, a little over 15 years now. Before that, I worked for my dad. First of all, he moved us here in 1994. I was 9 years old. My dad's basically been a CPA here and doing tax ever since then, up until he retired a couple years ago, and he is currently enjoying his retirement right now in Florida. If you don't know me, there's probably a good chance you know my parents. If you forgot what they look like, this is some couple of recent pictures that I found of both my dad, my mom, and then me and my brother over there at Hanging Lake from when we first moved here. So if you see him around town, you'll recognize him. So the main things I'm going to talk about today here are tax strategy and planning, understanding deductions, tax credits and incentives, and a little bit about new tax laws. That's a little bit of a murky one. These were the main categories that people showed interest in from the survey, I think. So we're going to start with tax strategy and planning. So one of the first things, if you're a business owner, that you're going to have to do is you're going to have to choose the right business structure. Basically, you have some options for the type of entity that you're going to be. If you are a business, you technically don't have to have one for the most part. People are going to form an LLC. From there, you have C corporations. Generally, C corporations are going to be very large companies, maybe hundreds of million dollars in assets, that type of thing. S corporation, the S literally just stands for small, usually a little bit closely held. Most of my S corporations are anywhere from one shareholder to maybe half a dozen shareholders. So for the next thing for tax strategy anyways, maximizing deductions. Obviously, when you have a business, you're going to want to take advantage of every deduction that you can, that you're allowed to. You don't want to miss out on any of these things. So here's a few examples. Probably the one I would point out is a home office deduction. If you're a business owner, you have a designated space in your home that is your office that you work out of, you are entitled to get a deduction for that. Just a couple other ones listed there. Depreciation, we'll talk about a lot of these later as well. So tax credits, here's just a few examples of some tax credits. Again, this is just something that if you have a tax professional or if you need one, these are the types of things you're going to be looking for. These are just a few examples. And we will talk about some more tax credits later on. Retirement plan contributions. My general advice is that you should always be putting something into retirement, especially as a business owner. If you're not taking salary, you're not taking wages, you're not paying into Social Security, you basically have nothing going into retirement. And that's something that I think everybody should think about, whether you're young, old, or anywhere in between. We should always be planning ahead and planning for retirement. Just a couple other ones, 401ks, IRAs, and then at the bottom here, deferring income and accelerating expenses. So essentially what this is just the time value of money. If you have the opportunity that you can delay recognizing income from December 31st to January 1st, you're essentially delaying when you're going to be paying taxes on that income for an entire year. And kind of this, it's basically the same thing with accelerating expenses. If there's a bill or an invoice that you can pay before the end of the year as opposed to on January 1st, you're going to be able to deduct in the current year. It's going to reduce your taxable income come April or April. Tax loss harvesting. So what tax loss harvesting is essentially if you have stocks or you're holding investments, you have one investment over here that you're ready to sell, it's going to make you $50,000. Over here, you have some investments that aren't doing as well, and maybe you're going to lose, say, $10,000, $15,000 on them. So if you have that opportunity, it makes sense to sell the ones at the loss to counter the ones that you're going to have a gain. So as opposed to having a $50,000 gain, you're going to have a $35,000 gain. Tax advantage financing is really just structuring any type of interest rate and any other legal type of thing in a way that yields long-term savings. For S corporations specifically, S corporations are probably the main entity type that I recommend for people who are essentially making over around $200,000. Now, the main requirements for an S corporation, as a shareholder, you have to take payroll. So there is no, if you're an LLC, essentially your net profit is just what you report on your tax return, that's it. Now, as an S corporation, like the example here says, S corporation earns $200,000 and pays the owner a salary of $60,000. Self-employment tax is only going to apply to the $60,000, not the full $2,000. So basically what that means is if you're the business owner getting a $60,000 salary, you're going to receive a W-2, you're going to pay Social Security tax, you're going to pay Medicare tax on that, but the remaining $140,000 is not going to be subject to self-employment tax. Now, that is pretty huge. If you're an LLC and you're a sole proprietor and you're just filing a Schedule C on your tax return and you had $200,000 of income, even if you paid yourself the $60,000 salary, that $140,000 of net profit is still going to be subject to self-employment tax. And that is significant. It's around 15%. So that's kind of the main benefit and really the biggest, strategy for people making that type of money. Now, if your net profit from your business is $25,000, it may not make sense. And that's essentially because payroll has costs. At that point, you're probably going to have bookkeeping costs, and S corps have to file a tax return. So at lower levels of income, it kind of doesn't make sense to do that. And the one other thing to mention about the S corporation, the IRS says that you have to take a reasonable salary. So like I said, payroll is required. Now, their definition of reasonable salary is basically there isn't one. So I have S corporation owners that pay themselves $3,000 a year. I have S corporation owners who pay themselves, $150,000 a year. I think they're both okay with what they're doing. One of those is probably more conservative than the other. Maximizing deductions, this is for individuals. Standard versus itemized deductions. The itemized deduction threshold has basically been doubled in the last 5 years. It is very difficult to itemize your deductions. As a married couple, you're gonna have to be over, for 2024, it's $29,200. Now, you get to include things like mortgage interest, your medical expenses over a certain threshold, charitable donations, and property tax up to $10,000. Even with all of that, it is pretty rare to be able to itemize your deductions. The thing I usually tell people is if you're a single individual and you have a mortgage on a $500,000 home, there's probably a good chance you can itemize. Or if you're somebody who donates to a charity at the end of the year, $50,000, $100,000, then you may be able to itemize. If you're not in that category, you're probably going to be claiming the standard deduction, at least for the time being. Tax advantage accounts, this is just retirement accounts that reduce IRAs, reduce taxable income. HSA, really I recommend an HSA for anybody who is eligible. To be eligible, you just have to have a high deductible health plan or no health insurance, essentially. HSAs are pretty popular. It's one of the things that I usually recommend people max out. Now, the benefit from an HSA kind of depends on what tax bracket you're in. If you're in the 25% tax bracket, contributing to an HSA is going to give you a tax benefit of 25%. If you're in the 10% tax bracket, obviously your contributions aren't going to give you as big of a benefit, but it's just one of those that when you dink and dunk these things across the board, they start to add up. Tax deferred growth, 529 college savings plan. If you have somebody, a son, daughter, grandson, nephew, anything like that, you can put money into those. They will accumulate, earn interest, and then they'll be tax deductible to the beneficiary. Capital gains and losses. I already mentioned the tax loss harvesting, basically just offsetting gains against losses. Holding period is basically if you have a stock, it's appreciated in value, you're ready to sell it, but you bought it 364 days ago, it may be worth it for you to wait one more day to get long-term capital gains treatment on that. So if you sold it on the 364th day, it's going to be treated as ordinary income, which is, for the most part, going to be at a higher tax rate than capital gains would be. For capital gains, a lot of times it's going to be 0%. It could be up to 20% now. In the past, it's been capped at 15%. Tax credits, obviously, you should be taking advantage of any tax credits you're eligible for. These are kind of some of the most popular ones. Obviously, the child tax credit, excuse me, earned income tax credit is going to be for lower income families. The American Opportunity Tax Credit is an education credit you can take for 4 years. Probably the biggest one on that one that I see is if you have somebody who's going into their first year of college, maybe they're only taking 10, 12 credits. Sometimes you can kind of lose out on potential credit by taking it in that first year. I'm somebody who graduated in 5 years, so I think there's a lot of kids probably out there like that, but if you take it in the first year, then you can't take it, say, in their senior year. And so you're getting a very small credit up front, whereas if you had waited a few more years, you probably would have got a more significant one when they're, about ready to graduate. So that's probably the one thing I would mention on the American Opportunity Tax Credit. There are still some energy efficient home credits. They're not too significant, but again, any tax credits you're eligible for, you should be taking. Income splitting, so this is just essentially you're allowed to gift $17,000 to basically anyone you want. So if you have children and you're wanting to essentially give them money without doing it through, they're not your employee or anything like that, that's one way basically just to disperse your wealth. Timing income and expenses, again, I kind of already talked about the deferring income and accelerating deductions. Tax-deferred retirement accounts, again, 401k is going to pop up a lot. 401ks can be pretty lucrative. Contribution limit for this year is $23,000. I believe for next year it is close to $25,000. A lot of these retirement accounts are going to have tools for older folks. Basically, it's called a catch-up. If you're over 50 for the 401k, you can contribute more. For a lot of the other ones, it's 55. On some of them, it's 60. But they give you an avenue to kind of contribute more if you've fallen behind or if you would just like to get more money in your HSA or retirement. Understanding deductions. So for businesses, essentially this is the main thing for a business expense to be deductible. It just needs to be ordinary and necessary. Ordinary is common and accepted in your industry. Necessary is one that's helpful and appropriate. An expense doesn't need to be indispensable to be considered necessary. What that means is not every expense that you have is going to be a business saving expense, and it doesn't have to be. So there's a little bit of leeway there. So here's just some examples of very common expenses. You have office supplies. Depreciation is you buy a piece of equipment for $20,000. Typically, something like that, you're only going to be able to take a portion of it, say 20% every year. But I'll show you that there are some avenues around that as well. Advertising and marketing, pretty self-explanatory. Here's some more. Travel, rent, utilities, professional services. I think these are all fairly self-explanatory. Now, these are ones that are not going to be deductible. So you have personal expenses, family trips, clothing, that type of thing. Fines and penalties, generally not deductible. Political contributions, not deductible. Commuting costs, same thing. Entertainment. So previously, meals and entertainment had been deductible at 50%. After 2017, entertainment is not deductible at all. The example I like to use for this one from a recent event was the VIP front row booth at the Jake Paul Mike Tyson fight that some law firm probably paid a pretty penny to get, and I'm sure they will probably try to deduct it on their taxes. That is not tax deductible. Some other ones here, club dues, extravagant auto and travel, personal health and life insurance is not deductible. So the key points really, again, just need to be ordinary and necessary. Another good takeaway is always have good documentation. Nowadays, having a digital copy of basically everything that your business has, whether it's income or an expense, you should have a copy of. Mixed use expenses are going to be expenses that a portion of it is business, a portion of it is personal. Only the business portion is going to be deductible. Now, there's going to be a lot of ways to determine what is the business portion. The one I usually go with is just to be reasonable with it. Tax credits and incentives. So small business owners, employees, individuals, there are a lot of tax incentives. I'm just going to go through these really quick. If you have any specific questions on any of these, or you want to go back to a slide and look at it a bit more, I'm happy to do that. I'm going to go through them pretty quick here. So small business healthcare tax credit, this is available to small businesses that provide health insurance to their employees through a shop marketplace. Work opportunity tax credit, this is for to encourage businesses to hire individuals from certain target groups, veterans, long-term unemployed individuals, those low-income individuals on public assistance, etc. Research and development tax credit. Essentially, if you have any sort of research and development in your business, even on processes or anything like that, there's a good chance you could be eligible for a credit on that. Employer-provided child care credit. This is if you're an employer and you provide facilities for child care, there's a credit for that. Disabled access credit, I think that's pretty self-explanatory. Same for credit for paid family and medical leave. The employer retention credit, this is actually one that no longer exists. It was big during the pandemic. It's had a lot of news coverage because it was, I'm gonna say, fairly highly abused, and I think the IRS is kind of catching up to that, but this one is no longer available. Section 179 deduction, so this is gonna be related to depreciation. I kind of touched on it earlier. You buy a piece of equipment, typically you're only gonna be able to take a portion of that expense over several years. Section 179 deduction, as well as bonus depreciation, is gonna allow you to deduct that today. So if you had $100,000 in income, you bought a $50,000 piece of equipment, typically you would only get to take $10,000 of that piece of equipment, you end up with $90,000 of taxable income. What Section 179 and bonus is gonna allow you to do is take the entire amount of that. So rather than having $90,000 in net profit, you're gonna be down to $50,000 in net profit taxable income. Energy efficient commercial buildings, there are still quite a few energy efficient deductions available out there. And then, so we have some Colorado specific ones. And like it says here, these are mostly geared to create incentives that help reduce tax level, promote job creation, and support economic growth. So you have Colorado Small Business Development Incentive, basically encourages growth of small businesses that are expanding or relocating to Colorado. Colorado Job Growth Incentive Tax Credit. This is if you're creating new full-time jobs. Obviously, there are some eligibility requirements on a lot of these that make them a little bit tougher to take, but Colorado Research and Development, R&D tax credit, much like the federal one, if you have even processes that you're putting research and development time into, you should be entitled to a small tax credit. Colorado Enterprise Zone tax credits, this is one, it's pretty tough to take. It's only available in certain areas. You would have to do a little bit of research. I think I have a little bit more on it at the end here. Colorado Manufacturing, Sales, and Use tax exemption. This is for Colorado businesses that purchase machinery, equipment, and related. Colorado Investment Tax Credit. Again, this is just tax credit for investments in machinery, equipment, and other capital improvements in Colorado. Colorado Film Incentive. This is for businesses involved in film, television, and other media productions in Colorado. And it's basically to encourage that to continue to happen in Colorado. Colorado Affordable Housing Tax Credit. I think that's fairly self-explanatory. Renewable energy credits and incentives. Colorado has several tax incentives for businesses that invest in renewable energy sources such as solar, wind, and geothermal. Historic preservation tax credit. This business is involved in the rehabilitation of historic properties and I believe preservation. Colorado, let's see, I think we had this one. Colorado sales and use for certain business inputs. This is related to agriculture. Colorado New Markets Tax Credit. This is to encourage investment in low-income communities and investing in those areas. So here's kind of the key considerations for the Colorado tax credits. A lot of these do require applying ahead of time, documenting things, submitting documentation to the state. Sometimes the state's pretty good about asking you for the same documentation that you already gave them once, several times, so you always want to keep that. A lot of them did have somewhat strict eligibility requirements. Obviously, the state-specific ones, if it's in Colorado, you're probably good. Outside of that, maybe not. And consulting with experts, obviously not everything here is a one-size-fit-all. Everybody's going to have a little bit of different tax situation. My advice on that is, to basically just always consult a tax professional. That can be me, that can be really any CPA, EA, anything like that. So new tax laws. I don't have a whole lot on the new tax laws. New tax laws are a little bit murky. So we were set to have all of the Trump tax laws from 2017 were set to expire next year. With some recent happenings, I think that's probably less likely. I think a lot of those are going to get extended, and I think we'll see a lot of kind of the same type of things that we saw when he was in office the first time. It's tough with tax laws. Unfortunately, our government has got to the point, there's a few years ago, they didn't finalize the tax laws for, I believe it was 2021 until March of 2022. So that makes things like tax planning pretty hard to do when everything's already in the past and you have no control over it. There are thousands of tax laws that get proposed every year, basically. So that's why I'm not going to dive too deep into that one. If you have any specific questions about tax laws and maybe my opinion on it, I would be happy to give you that. But other than that, I think if you guys have any questions or if you want to go back to any slides, we can do that now. Sure.
How are you, Troy?
I'm good. How are you?
Good. All right. So in your scenario where you had an S-corp individual making $200,000 a year,
Mm-hmm.
he was taking a salary of $60,000 a year.
Right.
He has $140,000 of outstanding money.
Correct.
And I would assume that that individual wants to use that money for expenditures that maybe aren't business related.
Sure.
How does he take that as an S-corp?
So as an S-corp, you can still take that as a distribution. So really it's available however you want. If you want to reinvest it in your business, you can do that. If you want to take it as a distribution and go spend it however you please in your personal life, it's yours to do that with.
How are you taxed on those distributions that you're taking?
So you're going to be taxed on, in that particular scenario where you had a net profit of $140,000, you're going to be taxed on that $140,000 in that tax year. Whether you leave it in the business or take it out, it's not going to matter.
But so what is the advantage of doing it as a S-corp? And because you're essentially paying the tax on the entire $200,000.
So I think probably the thing to think about is, so I guess maybe the better way to look at that is maybe the revenues for that business were $1 million. And then after that, you had the $60,000 of salary, but you also had another $740,000 of other expenses that you paid. So salary isn't going to be the only expense in that scenario. Sorry, what was the question again? I kind of lost my train of thought. Sure.
Tax on it, is the advantage of having an S-corp that you're paying a different tax rate as a corporation versus an individual?
So if you're, in that situation, as an S-corp, essentially the $140,000 is going to basically bypass self-employment tax. So if you are not an S-corp, you're just an LLC and you're filing a Schedule C, you're going to show that $140,000 of net profit, and it's going to be subject to self-employment tax. Yes.
What's the tax rate for self-employment?
15.3% is for both the employee and the employer.
Okay. And so as you as an LLC, are you paying that 15.3% as both an employee and an employer?
Yes. You do get a credit or a small credit for your portion as an employee, but it essentially comes out to around that 15%, yes.
Okay. And then so if you have those SHA, if you're making distributions into your SHA account, what qualifies you, or what qualifies a withdrawal under an SHA?
So
HSA, thank you.
Sure. So basically unreimbursed medical expenses. So if you have a qualifying medical expense, your HSA can be used to pay that. They've expanded this quite a bit. So now, if you go to City Market and you buy some over-the-counter drugs, that's probably going to qualify. Obviously, any prescriptions, anything like that is going to qualify. Basically, as long as it is a medical-related expense, you can use your HSA to pay for that.
And that can apply to your entire family too.
Yes,
So
yep,
my kids get sick, I can use it for their medical.
yep, absolutely. You and any dependents.
Okay. And then so the earned income tax credit on an S corp. So that same scenario, the individual is taking the $60,000 salary and they're saying I make $60,000 a
Right.
year, even though my company made $200,000 a year.
Sure.
And I don't know if that would qualify for the low income earned income tax credit. But if it did, maybe a better example is your S corp client who's only taking $3,000 a year.
Yeah.
Can they apply for that earned income?
So your S corporation income is still going to be taxable income. So it's still going to be subject to income tax. It's just getting around the self-employment tax. So on your tax return, you're not just going to be showing the 60,000. You're going to be showing the full 200,000. Yeah, which is going to be well outside of the earned income tax credit. It is pretty. I know in here it said low to moderate income. I would consider it to be a low income credit, or those available to low income individuals.
That's my question. Thanks,
Sure. Yep.
I have two questions.
Okay.
Let's see, on your HSA slide, it said that was a triple tax advantage. What is the triple tax advantage?
That might be a good question. I'm going to have to pull that one up because I do not know. So essentially what it's saying is you get tax deductible contributions. Once you have the money in there, it is technically a savings account. So you're getting tax-free growth. That interest that you earn is not going to be taxed. And then tax-free withdrawals. I would say that calling it a triple tax advantage is probably overstating the advantages of the health savings account.
Okay, other question.
Sure.
Let's see, I heard something about single owner businesses being less likely to be audited than ones that have multiple owners, numbers, whatever, something like that.
Sure. So I know on here, one of the advantages that it listed for the S corps is just by the figures that the IRS releases, S corporations seem to be much less likely to be audited. So I think what you're referring to is a single member LLC, which is basically you have a business that's just going to be reported on your individual tax return on a Schedule C. It is going to be a little bit more likely to come under IRS scrutiny. I'm not sure I can really explain to you why that is. I think I can just tell you that that is the case.
So S corps are less likely to be audited than the LLC.
Correct. Yep.
Would that be the same as if you went with a partnership instead of an LLC?
I'm not sure what the statistics are on that one. Partnerships, you have a couple options with partnerships. You can basically be treated as a partnership, or you can be treated as each individual partner. So there's a situation where essentially if your partnership gets audited and you've elected to do so, the IRS then can audit each individual partner involved in your partnership. I typically recommend for that reason not to do it, because a lot of partners don't want to be, they don't want their individual tax return audited because of something the partnership did or didn't do, or anything like that. As far as it being, I would say that the chances of being audited as a partnership are going to be lower than a single member LLC. Compared to an S corp, I'm not sure what the numbers are on that. But I think the general thing is, I think forming an S corp or a partnership just kind of legitimizes your business just a little bit more in the eyes of the IRS. There's really, I don't think it legitimizes it in any other way other than to the IRS. Anybody else? Yeah.
So I've heard a couple different brackets of income
Sure.
that are defined when you should become an S corp opposed to a single member LLC. And I heard you
Sure.
I've heard it 100,000. What's your thoughts and reasoning on that $200,000 number?
So I usually say around 150 to 250,000 is where it starts to become worth it. And really, it's just because the S Corp is going to have, you're going to have to file a tax return, for an S Corp. That could be anywhere from, I think my average S Corp client is probably under $1,000, but there are S Corp returns that run $5, $10, $20,000, and then payroll. Payroll is one of those expenses that it doesn't have to be a huge significant expense, but if you're doing a weekly payroll or a monthly payroll, there is a cost to it. And so I think, that's the biggest thing is the amount of net profit that is avoiding your self-employment tax. Is that going to be more than what you're paying for payroll and to have a tax return filed and to, basically probably have some bookkeeping and some other, not huge, but small expenses that do add up.
Troy, can you touch a little bit on the new, I'm going to mess this up, FAMLI?
Oh, gosh.
The family, can you touch on it? Because I know it's a newish reporting thing. I'm going to be honest, it confuses the hell out of me.
I'm going to be honest, I have not done a lot of payroll or payroll-related stuff in the last couple of years. I don't know that I could really tell you much about it.
As business owners, I'm up now, I think this is going to be the big year for it.
Yeah.
And I think that a lot of business owners are just going to be
Yes, and
over the coals by it.
And to me, it felt like one that was rushed through a little bit. I know a lot of people are not really sure exactly how to handle it. That's probably one that I would have to do some more research into, and I could certainly, maybe answer some questions for you down the road on that. Sorry. Sure. Hi. Yep.
At what point, income-wise, does it make sense for like a 1099 kind of small contractor to become an LLC, income-wise after expenditures?
There's really, forming an LLC essentially just kind of protects you liability-wise. If you don't form an LLC and everything is just, basically your business is you as a person, if you have anything happen and you cause damages or anything like that, you're sued, you have no protection. So your house could, potentially not be protected in that type of sea. So forming the LLC is mostly just to protect you from that type of thing. As far as there being like an income amount or anything like that where it makes sense, there really isn't one. To me, it's very cheap there's not a lot of costs associated with forming an LLC. So if you're starting a business, you have a business that's growing or you're planning to grow it, I think it makes sense to do that just to reduce the risk that you have. But at the end, your tax liability, whether you're an LLC or you just have it set up, under your social security number, it's not going to matter.
Kind of piggyback off that question.
Sure.
If someone's operating under an ITIN number,
Mm-hmm.
is it working in their advantage? Because my understanding an ITIN number and an EIN number are different, but they're really similar in that sense. Does it make sense for that individual to file, like maybe for an EIN number and do their employment under that business entity if they're looking to make income?
Probably I don't know about that. I think probably the only thing I would say is, and I guess I haven't mentioned this. So if you do have an LLC and you decide you want to make the election to become an S Corp, if you had an I-10 under your LLC, when you do an S Corp election, you will have to get an EIN. I'm not sure if that really answers your question. I think I-10s and EINs, for the most part, are interchangeable, but that's kind of the one requirement there where you would be required to get an EIN when you're going from a single member LLC to an S Corp.
I think what I'm referring to more is, a lot of individuals who aren't documented but are working.
Sure, sure.
Get a lot of pushback from employers.
Sure.
They're like, the tax reporting for that type of individual
Sure.
becomes a little bit more difficult. So, does it make sense for them to have that separate number and run their own payroll, run their own stuff under their own entity?
I think it probably depends on the individual circumstances. I'm sure there are a lot of situations where it does make sense to do that. I think it might be, in my opinion, there might be a little bit more comfort on the side of the employer or the business who is paying them or, using their services, that they would prefer that you have an EIN. But I don't know that there's really any advantage, unless you're required to get an EIN. I don't think there's really any advantage to doing that. Anybody else?
Guys, I'll keep them going.
Yes. Sure it is. Legal and professional expenses are going to be deductible. The legal side of that is a little bit more murky. If you are breaking the law and you have legal expenses associated with that, that is not going to be deductible. And that probably falls under the fines and penalties type of thing. But yeah, if you've hired somebody to, say you hire a lawyer to draft a contract for you or something like that, that's an ordinary and necessary expense. If you have an accountant who does bookkeeping, that's ordinary and necessary. If you have an accountant that does your tax return, same thing. Sure.
An individual with an LLC
Mm-hmm.
who has kind of free market health insurance, is that deductible? It's personal, but it's kind of still necessary.
So yeah, if you have an LLC and you pay for insurance, you can take a self-employed health insurance deduction. That's basically just going to be limited to your net earnings, so you're not going to be able to create a loss or anything like that, but it would be deductible, yes. Yep.
I have a friend, she has a business that her business, she rents the building.
Mm-hmm.
She just had to put in like an $8,000 HVAC system, even though she doesn't own the building.
Sure.
She still write that off on the taxes.
So for that one, for HVAC, it's going to fall under something that's going to have to be depreciated over time. Typically, capital improvements to like a business building, you're going to have to take over 39 years. In that case, the IRS has actually carved out a situation where you could deduct over 10 years, and currently you could deduct the entire expense in 2024. That's probably going to go away. And I shouldn't say the entire expense. She can probably get some accelerated depreciation on that. But generally speaking, if there were not tax laws allowing her to take that, she would have to depreciate it over a very long amount of time. Yep. So 179 is actually not available for building improvements. But the one I mentioned with the 10-year, so rather than having to take it over 39 years, there is currently a tax law that would let you take it over 10 years and then potentially even maybe the majority of it in the current year. But yeah, typically capital improvements you're gonna have to take them over time. Did somebody have something over here? Correct. So this would basically be just driving to your job. So when I drive to my office every morning, that's not deductible. Now, once I get to my office, if I'm traveling somewhere from there and back, that would be deductible. But basically, commuting is just driving from your home to your place of work.
How do you distinguish that for somebody who is, kind of on the road for both? They're on the road for their jobs and also commuting to and fro.
So the IRS is basically going to say you have your home and you have your place of business, and that is going to be determined on some varying factors. For that one, I'd probably need to know specific circumstances. Now, if you're an employee, you can't really deduct mileage. If you are a business owner, then you can kind of take advantage of that. But as an employee, it's essentially your employer's responsibility to reimburse you for mileage expenses that you incur. You used to be able to take unreimbursed employee business expenses. that was essentially removed with the 2017 tax laws, that would be a situation where you would be able to take your travel while on the job. But for now, there's really nothing you can take advantage of there. Yep.
To piggyback off of that, what's the best way to track that? 'Cause I drive a lot.
The first place I usually recommend people start is on January 1st, write down your mileage. On December 31st, write down your mileage. Now, you really should keep a tax log. So every time you get in your car and you're about to make a business-related travel, you should write down either the starting mileage or just record the mileage that you drove that day. Tax mileage logs are unfortunately pretty tedious to keep track of, especially if you're traveling every day. For me, as long as you're reasonable about it, if you drive every single day and you drive 50 miles, you don't have a mileage log, I'm probably gonna take it for you because you're estimating it to the best of your ability. Now, the IRS could come back and say, where's your mileage log? And if you don't have one, they could throw that out. And at that point, you're gonna have some back taxes and stuff like that. But to me, if you're incurring the expense, I'm gonna err on the side of taking it for you. I'm gonna explain that there's a potential for the IRS to come back and want your log. And at that point, you may have some money to pay them and some issues. But for the most part, I think as long as it's reasonable, that's the most we can kind of ask for. Anybody else? Kevin? No? All right, well, I really appreciate everybody coming, and I do have some business cards I'll put out front if you want to take one. If you have any other questions you want to email me or call about, sure.
I get asked all the time, because I'm a financial professional.
Mm-hmm.
And people ask me, do you know a CPA?
Sure.
And I'm like, no, I don't, because nobody's taking anybody, it feels like.
Yes, it's true.
And everybody, all the CPAs are very busy, so what would be your suggestion of a business owner or individual's way to get in and see one when nobody's taking anybody?
Well, I guess obviously probably my first advice would be to call me and see if we can set up an appointment and if I'm able to take them on as a new client. Unfortunately, even in the Valley, my dad's firm sold a couple years ago. That firm that bought him out bought out 2 other firms in the Valley. They closed their doors last year. So we're down at least 4 CPA firms in this Valley, and as far as I know, we only have 1 new one, and that would be me. So the issue you're speaking of where there's a shortage of CPAs and tax professionals is very real. And, I like to think that I can help everybody out, but it's just not realistic. If they need to find a CPA, I don't even really have anybody else to recommend, unfortunately, because I think for the most part, I have more clients that are coming to me from these other firms that are not able to help them out anymore and that type of thing. So beyond that, I guess just try to stay persistent, keep looking. Hopefully the industry will get some new young blood here soon, but there aren't really any, I'm not anticipating that happening. So it will be tougher and tougher to find somebody. If you do find somebody and they're good, don't let them go. Yep.
Can I just see that slide where you mentioned your employer providing child care?
Sure. Oops. So that would be this one. Anybody else? All right. Well, thank you again. Is that it? Okay.